what is that thing that could really change your life from having way more than you need to having way less than you need? That is.
Welcome to Retire Today. I'm your host, Jeremy Kyle, and we're here to help you create your dream retirement. Today, we're talking with Paul Merriman about how to supercharge your retirement. Paul, welcome to the show.
Jeremy, it's great to be here. Thank you.
Yeah, glad to have you on. I was talking to someone that we both know in the FinCon, the financial blogging, YouTube, and education community, and he said, Paul Merriman, there are a lot of people that are big fans of Paul Merriman. So I agreed. I've become a big fan. I hadn't met you before, so thankfully we sat down at a table next to each other, and it was wonderful to meet you. You've got a great story. I want to have my listeners learn about you and what you do. So thanks for coming on the show.
I appreciate it. And I just have to tell you, I got a copy of your book, and you have done a fantastic job. And I was curious how people responded to it. So I went to Amazon to see what kind of reviews you got, the written ones, not the ones where people just come there and check. Every one of your 32 reviews are a 5-star review. I didn't come close to that with my book, so I'm envious, and I'm
Oh,
proud
well,
of
thank you,
you.
Paul. Thank you, Paul. Awesome. Well, you mentioned you wrote some books, but before you were writing books, you were an investor. You were a stockbroker. You actually used that term, stockbroker, back in the 60s. What was investing like back then, Paul?
It's amazing how different it was because it was so inefficient. It was efficient for Wall Street, but when you looked at the expenses and the commissions and the fact that almost everybody was paying 8.5% to buy a mutual fund to start your long-term investing, it was outrageous, but that was the way the business worked. And of course, today, I tell young people, you ought to be able to make a lot more money than I did because you're going to pay a lot less and you're going to get a much, much better product investment today than you did back then.
Yeah, it's a nice situation to be. And some people listening say 8.5%. You got to be kidding me. That was the case. It was the case. When I came around, it was more like 5.5%, but close to zero. You'd be hard pressed to find a mutual fund with a commission. That might be a needle in a haystack these days.
Well, it's obviously somebody who hasn't gotten any of our information, but
Right.
but the bottom line is nobody ever questioned that 8.5% or the 5.5%.
hmm
Very few investors understood what that money costs you to not get the return on that money. And so, while it seems outrageous, nobody ever challenged it.
hmm Yeah, well, it's just a lot of things people don't realize, and they're missing out if they don't realize it. They don't dig into it. You wrote a book. I've got the book right next to me here. You call it "We're Talking Millions: 12 Ways to Supercharge Your Retirement." We're going to try to highlight some of those ways to supercharge your retirement. But you start out each chapter, each one of these ways with a quote. And this one quote I think is really relevant because we're talking about this large 8.5% mutual fund cost back in the day. You quote John Bogle, who said, "The two greatest enemies of the equity fund investor are expenses and emotions." You just mentioned the expenses. Tell me a little bit more about that, but especially on the emotion side. What's so dangerous about expenses and emotions?
Well, what Bogle would say is that market returns come and go, but expenses, they go on forever. And a 1% expense ratio versus getting a fund free, and there are a few where you can get that. If you had the same portfolio, the difference over a lifetime for somebody who's starting from scratch, putting away, let's say, $6,000 a year for 40 years and then living off of it, that out of pocket cost is about $3.5 million because of that difference of 1%. And I don't think many young people know that. But then if there's that kind of cost for overpaying to be in a mutual fund in the first place, you might say, okay, then what might it cost if your behavior isn't good? Bad behavior actually, literally, can cost an investor more than 1% a year. And that bad behavior is so right at the moment. It feels so good to get out of the market and get out of a market that's going down and find a safe place to be. It sounds like you're being protected, but in fact, you're probably doing some damage to the long-term return.
Yeah, I'd have to agree with you. And by extension, John Bogle, I did a podcast series a few years back, maybe 2 or 3 years ago. I went through the top three, um, I guess, dangers or risks. It was the top three risks to your retirement. I had inflation, I had market volatility ups and down, but I came in and said the number one risk to your retirement is yourself,
Yeah.
and that's exactly it. Bad investor behavior. That's I like that phrase.
Could I suggest something, Jeremy, that might come in above that?
Let's hear it.
And I've thought so much about this over the years. What is that thing that could really change your life from having way more than you need to having way less than you need? That is the source of your education.
You've been saving your whole life for retirement, but how do you actually retire? My name's Jeremy Kyle, and I take my clients through a 5-step retirement planning process so they can be ready for retirement. I put that whole process into my book, Retire Today, so that you can create your retirement master plan in 5 simple steps. If you're trying to create your retirement plan, head on over to jeremykyle.com, JEREMYKEIL.com to buy your copy of my new book, Retire Today.
What you learn about the investment process, because if you have a good teacher, and I'm thinking about your book here for a second, because you go through this step by step, but if you've got a teacher who puts it down clearly, what is in your best interest, it ticks off all the things like expenses and emotions. And I mean, it may be that the right source of advice on day one is going to be the biggest contributor to your long-term success. Of course, you got to save money. That's up to you. But beyond that, that base of knowledge is so important.
Yeah, no, I agree. And that's what you're doing now. We said earlier you're a stockbroker. You were in that world, if you want to call yourself a stockbroker or a financial advisor from back then. But now you've switched it around. Speaking of teachers, you've been focusing on educating investors. You've got nonprofit. What prompted that change from maybe a financial advisor to financial educator?
Well, really, what happened was I sold my business at age 70 and wanted something to do. And my wife, she really was the one that lit the fire. She said, isn't there some way that you could share what you know with young investors? And so I got tied up with my old alma mater, and they said, yeah, go at it, start teaching our kids. So we set that up. And then I got invited to write for Market Watch, and without pay, but I was happy to do it without pay because I had a chance to get to a whole bunch of students in a way that I would never have been able to get to before. And also, at about that time in my life, I was on one of those PBS special Pledge Week
Hmm.
things where you yell and scream about something you teach for an hour, and then you beg for 15 or 20 minutes for money for the stations. And that got me in front of about they say about 40 million viewers. And so that really got me excited about continuing to teach. So that's what I'm doing. Oh, I'm a completely volunteer guy, and the team of people who work with me on all of the things that we do to educate people, they too are volunteer. And so I'm having a ball, and I would like to keep doing this for as long as I possibly can.
Yeah, well, that's good to hear. And one of the things you're teaching, you're teaching a lot on the world of investing, specifically. I think even really mainly on the stock investing.
Yes, yes.
So I'm curious because
Yeah.
I'm learning more about the things you've written. Looking at your website, it seems like you've I don't know if develop's the right word, but you've popularized a few different ways to approach investing. You call them sound investing
Yeah.
portfolios. You've got quite a few on the website, but one's like the 2 fund strategy, the 4 fund strategy, the buy and hold for life strategy. Tell me about a bit about how did you come up into this idea of the sound investing portfolio, and how would you suggest someone start using them?
Well, to begin with, everything that I've learned about asset allocation, I learned at the footsteps of Dr. Fama and Dr. French and the people at Dimensional Funds and now the people at Vontis. But these are people who come from an academic background and believe that you can build portfolios not only to have massive diversification with numbers of companies, but that it's also very important to have many different equity asset classes in the equity part of the portfolio, whether it's 10% or 100%. You should, according to the academics, take advantage of putting together more than just one asset class. And in 2017, I met with John Bogle, and I had been teaching people about how to build the portfolio using 10 different great equity asset classes, all of them winners over the long term. You don't know about the future, but you hope that the future will look something like the past. But you got to spread amongst 10 different equity asset classes so you were well protected. Well, he waggled his big long finger at me and he said, "You cannot do that to people. They will not, as a do it yourself investor, use 10 funds. They won't know how to rebalance. They'll have excuses for not doing the things they should do, and they'll start deciding they're going to get rid of one because it hasn't been doing well lately." All of those emotional challenges you mentioned. So I came back to our team, and Chris Pedersen, our director of research, a retired engineer from software guy from NVIDIA, really bright, really caring, volunteers hundreds of hours a year to working on the strategies. But he helped put together fewer than 10. What would happen if you only had two, if you only had four, if you had six? I mean, and different combinations of small and large and international and US, so you could show people what are the long-term implications going back to 1970 so we can see how it holds up in 73, 74, 2000, 2002, 2007, 2009, because we want to help people get through those bad times as easily as possible. And what we found was with just simple portfolios that anybody could do, you got just as good a return, if not better, than all 10 of them.
Hmm.
And so we put those portfolios out there. Everything we do is free. And so we're not charging anybody, but we think it's going to help a lot of people who want to do it themselves. Now, I know from having been in the business, I was never a financial planner like you are, Jeremy. So any help I could be was a fairly narrow focus, and it was on the investing part. But I do know that today, people who learn how to use these, and you put that together with all the fancy stuff that you have learned to be a financial planner. And by the way, it just makes me kind of almost a little embarrassed that we were managing money for people, millions of dollars, kind of pretending to be financial planners in a way. But in the beginning, we didn't have anybody with a CFP. And I look at that alphabets, that series of things that you are. In fact, how many things are you in terms of designations in the industry?
I'd have to count, but you're talking about like I've got the certified financial planner, chart financial analyst. So you got CFP, CFA, CHFC, CLTC, all these ones. It's close to 10. You can tell I like to read, I like to learn, and I like to educate. And so you
Yeah,
can't educate if you don't know what you're talking about.
I
And I figure, what's the
totally
point of
agree.
learning if you don't help others?
That's
I
right.
think we're in the same boat here.
That's right. That's great.
So you had this ultimate buy and hold strategy, called it, which I think is 10 funds. You kind of challenge Chris Pedersen, see if you can bring it down to two, but you mentioned you've got a 2 fund, 4 fund, 6 fund, kind of different options for people to learn. And you're just putting
Mhm.
it out there. It doesn't seem as if you have a favorite, or you're saying this is the way you ought to do it. You're saying, let's just take a look at what you could do on your own. And I can agree a bit with John Bogle that, yeah, if you can get it down to 2 funds instead of 10, you might be more likely to follow the rules or follow kind of the investing principles. But some people look at it and say, yeah, that just can't be true. 2 funds, how can it possibly be? And they can kind of pick the level of complexity they want, the 4 funds or the 6 funds. So I like how you've kind of brought this up. I'm understanding now. I thought, why is he putting out 15 different ways to invest, right? Usually say this is the one way to invest, is what you might hear from an investment salesman, perhaps. And that's what it is. You're investment educator.
Well, and I do think that the other thing that's so important, whether it's 10 funds or 2 funds, is not only what do the good times look like, because that's what people want, but what do the bad times look like? So we make it very obvious the challenges you're going to have on the downside, including the worst year, the worst 3 years, the worst 5 years, the worst drawdown, so that going in, you will know how much risk you're taking. We don't know what that return is going to be because
Mm-hmm.
you can look at 25-year periods. In one 25-year period, the S&P makes 8 and another it makes 17.
Yep.
So we don't know, but we do know what the bad times are likely to be. So that means we also, in order to truly help investors do it themselves, we have to show them how much fixed income they need to have in that portfolio. So not only do we have tables that show it all equity, but we have tables that show every combination of equity and fixed income with every strategy, including the bonds, of course, so that you have an idea of the ride you're about to go on.
Yeah, that's a good description. It is the ride you're about to go on. That's one of your 12 small steps with big payoffs. You call it small steps with big payoffs. Number 9 is buy and hold. Avoid the most common timing traps. And that's the problem, is people don't realize it's a ride. They're trying to do the market timing. You warn against market timing, especially you call one version of it the I just can't take it anymore approach.
Yeah,
Tell
yeah.
me a bit about that. The I just can't take it anymore approach to investing. Why it's so dangerous.
Yeah, the ICSIA market timing system. You know what people want to know very often when they ask me about investing is what is the market going to do?
Yes,
And
I had
they
that call. I had that exact question today. So, what's the
and
market going to do over the next 4 months? I
yeah,
don't know. I
I
don't know.
mean, we could laugh, but the reality is Wall Street has trained people to think in the short term. And so, my view is to tell people, you ask me how I think it's going to do. I say, well, I can give you a range over the next 40 years. I know the S&P 500 had the worst 40 years that made 9% a year, basically, and its best 40-year period was 12.5%. And if you adjust those returns for inflation, they were within 1% of each other. So I'm really feeling good about the next 40 years. But in fact, I don't even know what that's going to be. But I do know this, that when the market starts down, people panic. We both know all the statistics about how people feel about losing money. They hate to lose money, and they have a sense, because they think linearly, that the market's going to keep going down, and that they're going to, in fact, some people think they're going to lose everything, even if they're in a diversified mutual fund. We know that is crazy. but it doesn't change the fact that that's where people's minds are, and we have to work very hard to change it. And in fact, I know, having been around the investment advisory business and a long time, I know that your biggest job in terms of the investments that you're helping people with, your biggest job is going to be to keep them committed to the market when they are in it and it's going the wrong way. And you, of course, have to be honest with them and say, look, I don't know where the market's going.
Mhm.
It could go down further. But when we built your portfolio, we built it with the assumption that you were going to accept a certain amount of risks. Now, do we need to talk about changing that? Have you decided you don't want to accept a 50% loss in your portfolio? Well, if you don't want to, you shouldn't be 100% in equities.
Mhm.
And then it's our job to figure out what is that right combination. And then when the market's going up and you get a call from them saying, God, how come we aren't moving into the market here, Jeremy? And you say, wait a minute now, remember that heart to heart we had? That is the biggest job you're going to have over the next 30 or 40 years if you stay in the industry that long, because that's where the big problem comes. Behavior, bad behavior, but bad behavior only comes from real fear. And we have to try to figure out how to manage that. And I say, good luck.
Yeah. Well, it's manage the fear. I think manage the fear, a lot of it's the fear of the unknown. I think part of it is because you just you don't have a plan. You kind of
Yeah.
invested, you did well, but you don't have a plan on taking the money out. And when you have a plan to take the money out, and just like you said, you're accepting a level of risk. I say you can't control the return. You can't choose your return. You can choose a level of risk you're willing to put up with.
Yeah.
But even then, you can't control what that is going to look like day to day. And having that plan is a key part of it. Part of that plan, especially we're talking a lot to 60-year-olds, basically
Mm-hmm.
62-year-old couple retiring from a corporation is who listens to the show. And you told me in our pre-call yesterday you do a lot of research on retirement income withdrawal strategies. That's what I found. You're 62 years old. You've been investing for 35 years. You haven't been taking money out for 35 years. So it's a new skill. But in your research, you find that a lot of people kind of approach it like, well, they put money in. I'm putting in money in on a consistent fixed amount basis. So they kind of assume that they're going to take money out on that same kind of strategy of if I put in $2,000 a month, I'll take out the exact same amount, a consistent amount every single month. Tell me this difference. You call it a fixed distribution, so kind of taking out the same dollar amount or perhaps percentage versus what you call a flexible distribution, trying to help people figure out their retirement withdrawal plan. What are you seeing in this fixed, consistent distribution versus a flexible distribution?
Well, Jeremy, I don't know what part of the industry you like the most, but for me, that initial introduction to the investor, typically a couple, and having a chance to explore where they are, how they got there, where they think they're going. And I'll tell you, when I opened your book, I always go to the table of contents. And I don't mind if the title of the last chapter is the most interesting, I'm going to the last chapter.
Oh, there you
And
go.
when I saw the chapter on the most important number,
Okay.
well,
Yes.
I'm a numbers guy.
All right.
And I immediately opened up that chapter. And your point was well taken that the most important number is not inflation and a whole bunch. It is knowing how long you expect to live. And people don't have that. And if they don't have that right, then they're going to do a lot of really bad planning potentially. But having said that, if I know how long you are likely to live, and I know how much money you have, I'm thinking to myself as an advisor, does this person have enough? And John Bogle, when I met with him back in 2017, he is so much about enough. I couldn't believe how often enough came up in the conversation. I actually am focused on more than enough. That is what's important to me. And I'll mention why. But If somebody only has enough, then we are probably got to be very, very careful how much they take out, because we're going to be forced to adjust that amount by inflation because they just have enough. On the other hand, if they had more than enough, then we can go, and rather than a fixed with adjustments to inflation, we can go to a higher percentage being taken out because we don't have to worry about the inflation. We've already got that cooked into the saving that we've done. Has taken us to a point where we can take out 5%. If the market goes up, my wife, who loves to spend the money in the family, and I'm happy to have her spend it, as long as she doesn't spend more than the 5% of whatever that beginning number is at the first of the year. On the other hand, if the market was down the previous year, it means my wife and I are going to take a little cut in pay, and we're going to take out 5% of the lower number, ignoring inflation. But to begin with, because we had oversaved, that meant that we could take out more than we needed. And what we do, if we don't need it, don't spend it, we give it away. But
Hmm.
we're taking that 5% out. And I found that with couples where one is a spender and the other is a saver, that variable or flexible distribution strategy was by far the most favored. The problem is you need to have more than enough. And very often somebody would come in and say, we have this amount, and I'd like to do the variable flexible. I'd say, that's great, but I want you to work for 5 more years. And they didn't want to hear that, but that's my job, is to tell them the right thing, and your job too, once you know the circumstances. And that's the beauty of the folks like us that love all those numbers and probabilities, and of course, at the end of the day, all you can do is do the best you can. But boy, once you know who they are and what they believe, it is amazing how neatly you can put a package together for an investor.
Yeah, and you're trying to help them do the best thing. It's interesting how you said for that example, couple, sometimes you got to tell them to work longer. I've done some research, like to kind of play with the numbers around, and it seems like to me, if you happen to have less than $500,000 and you are trying to retire and you're 62 years old, the only way to improve your retirement, you can't magically pick better stocks. You can't try to save a bunch of taxes. It doesn't really affect things materially. It's either, or probably both, work 3 more years and or wait 3 more years on Social Security. Those
Yeah,
two factors that you can control were the big difference. Your stock picking or your tax planning, that really didn't seem to make any difference at all when I was trying to run the numbers on it. So sometimes that's the answer,
interesting.
is not
Yeah.
investing. It's working or changing your Social Security decision.
Well, and by the way, I think it's also important to note that most people do not understand. Let's say you've got $1 million portfolio, and if you go from 40% to 50% equity over a lifetime, that can add an extra $1 million to what you spend and what you leave. An extra 10% equity, whether it's the S&P 500 or the four fund strategy. It'll be a lot more theoretically with the four fund strategy, but it would be good even with the total market index or the S&P 500 if that's the way they're investing. But that extra 10% is a pretty big deal over the long term.
Yeah, it helps out. I'm going through some of your small steps with big payoffs. That's one you're talking about. Number 3 is rely on stocks, not bonds. You've also talked about number 4, own mini stocks, not just a few. Focus on index type of funds. And I can see where you got a lot of that inspiration if you had the chance to talk with John Bogle. There's some things like number 2 is start early. You've got a lot of your ways to grow over time. I like this. You're trying to hit people at the right time, start early. A lot of this, I think, is focused on helping younger investors start off on the right foot. What would you say to someone who's 62 years old? They want to retire. Where should they start?
Well, first of all, let me just say to follow up on your comment about the newborn child. That 62-year-old, and I'm almost 82, and I got my youngest is grandchild is about 3.
Hmm.
When my kids our grandkids are born, there's a little bit of money put aside. And
Nice.
one of the things we show, a dollar a day over a lifetime is about $1 million
That adds
at,
up.
at market rates of return. So, but where do you start? That is a kind of depends on the feeling that I get when I was in the trenches like you. What I would do was try to figure out what do they believe about investing? And I would ask them, for example, which would you think in terms of as your primary goal as an investor? Would you want to beat the market? Is that what you want to do with your investments? And I would say, even if we're just talking about the equity part here, I mean, we don't expect to beat the market with a 50-50 bond stocks, but with an all stock portfolio, it could be that what you want to do is beat the market. Or is it that you want to find the best return you can get within your risk tolerance? Or is it that you want to find the lowest risk way to achieve the return you need? Now, if you choose the third one, what you're telling me is that we need to sit down and figure out what you need in order to tell you what the right combination of portfolio. And that's why we have all these tables to be able to say, look at these tables. Here's what you would have gotten. But I always say, take 2% off that. Don't count on getting that return in the future. But if what you really want is to get the highest return that you can within your risk tolerance. We need to spend time talking about your risk tolerance to find out, because if you tell me you're willing to lose 25, 30% of the value of your portfolio at this time in your life, then that means the most equities you should probably have in your portfolio would be 50 to 60%. And if you tell me how much you're willing to lose, and you want me to get the best return while you lose that, then my obligation, and they don't like this answer or my comment, my obligation is to give you a portfolio that does go down that much. That's what you're asking me to tell you.
Hmm.
At which point they say, well, I didn't really mean that. I don't want to lose that. I don't want you guaranteeing I'm going to lose that. Well, the market is likely going to do that to you if you have. So that's what I used to do. I love that whole process of the getting to know you, hour and a half. I suspect you probably spend 5 or 6 hours over a series of meetings before you know what to do with a person. Is that approximately what you take?
Yeah, well, it takes time because
Yeah.
you're, in my mind, you're building it out. And you mentioned taking a look at my book. Setting up the investments is step 4. You've
Yeah.
got to learn about the person and go through one,
Yeah.
2, and step 3 before you get to you're clicking the buttons and making the money move around left and right. And like you said, you start with your goals, your beliefs, and the goals and the beliefs of the client. I find sometimes the goals and beliefs of the advisor, where they say you ought to be 100% stocks or you ought to be in annuities. No, they ought to be in the types of accounts and products that help them achieve the goals that they have, whichever way it
Uh,
happens to be.
and I got to wave a red flag, Jeremy, because while I can't name names, there are people in this industry, well known people in this industry, that will advocate for almost any investor that they be almost 100% in equities, regardless of their age. And as best I can, if I get a chance to sell somebody, I don't want you going there. I mean, I'm not in the industry anymore except as a teacher. There are very few people I ever met in all the years I was an investment advisor and in the trenches that had the risk tolerance of being 100% equity, even at age 62. when you really test them and talk with them and find out the kinds of things they've done in the past when they felt under pressure because the market was going down. And also the fact that that company is talking to the, in many cases, the spouse, basically,
Mhm.
they're totally ignoring, I think, and I don't know how you deal with this, but I used to fight to make sure that we got the feelings of that spouse that was not involved in the process. I remember
Mhm.
one time we were having a meeting with this couple, and he got up to go to the restroom, and she stayed, and I asked, because he's all equities and he was just retiring and had technology stocks, almost his total portfolio. And he left, and she broke down crying because she was scared to death. And by the way, it turned out she was absolutely right. And when they left the room, what we negotiated, whether we managed money or not, I said, look, you let her have half of that money in your IRA. You can do that. You can give her the right to tell an advisor or to
Right?
tell a
Yep.
mutual. And he did. He let her, because he could see after he came back that she was upset about something, and he was left to do what he wanted to do. And I really think in some ways that probably added some really good lives to years to their life, because in the end, that guy ended up turning his part of the portfolio over to an advisor to manage as well. So it's such a fun business, and it's so complex. And who you deal with, boy, I'm telling you, you want people who really are willing to learn about you and service you, not just as a bunch of numbers, but as people who have feelings about their financial life and their family, because they all go together.
Yeah, that's right on. And I want to learn just a little bit about you, Paul, because you mentioned that you sold your business about 12 years ago now.
Hmm.
I think you call yourself retired. I'm curious, how is retirement going, especially in, I'm imagining, tell me if I'm wrong, I'm imagining you're taking more money out of your investments than you're putting into your investments. And I know that's a hard switch. How have you dealt with that the past 12 years to be somebody taking money out of your investments, uh, doing the opposite of what you've done for so long?
Well, it all started with a couple of agreements with my wife. And I talked earlier about that variable flexible strategy that we use. I got her to buy into that idea that we would have different amounts of money to spend each year. We would know that amount of money at the first of the year, and that has worked beautifully. And if you look at the studies, it is amazing that one little defensive step of being willing to reduce the amount of payout, it has an absolutely gigantic long-term impact on the portfolio. And we have tables to show that. But that was the one agreement that changed, set up my retirement life financially. Now, and we had oversaved for, so I know we don't have a challenge with having enough or not unless something catastrophic happens. The other agreement that was important was I promised my wife I would never, ever work for money again. Sometimes people will pay me to speak, and I just have them give that money to our foundation. I don't take a penny for the work that I do. I already had enough good fortune that I don't need to do that, and that always creates potentially some conflict of interest. No, I don't want that. I just want to be a teacher. But here's the only challenge I've had. When I promised my wife I would never work for money again, what she heard was I will never work again.
There you
So
go.
she is still waiting for me
Yes.
to retire, but I will tell you that again, I've compromised. I'm not a sun worshiper, but we go down to California where there's sun for basically half of the year, and then the other half we're up here in the Pacific Northwest. And so it's not like she doesn't have everything that she needs. She just wants more of me, and I, coffee together, lunch together, dinner together. I get up between 3 and 4 in the morning and go to work on what I'm doing. I love what I'm doing. And the only thing I can't do, I cannot be an investment advisor anymore. I can nudge. I'm a good nudger, but I cannot give specific advice. But if I have done a good job of educating, then hopefully that will help people get to where they find comfort in doing the things that we recommend generically.
Right. Yeah. Well, I think they are there and they're learning quite a bit. I've got one more question for you, Paul.
Yeah.
Before I tell us what's the best way to reach out to you?
Oh, Paul at paulmerriman.com.
Yeah.
I mean, I will try to answer
Easy
all
enough.
questions, and the website is paulmerriman.com.
Yeah, perfect. Well, we'll put the website in the show notes so you can learn all about Paul's sound investing portfolios. He's got it's a PDF. I didn't have to pay $1 or a penny even. I downloaded the PDF of 12 ways to supercharge
Yeah.
your retirement. And of course, if you want to learn about how our team helps you create your retirement master plan, it's 5stepretirementplan.com. So head on over there as well. Okay, final question for you, Paul. Tell us
Yep.
something about yourself that few people know about. And remember,
Oh,
this podcast is rated clean.
I'm going to guess 99% of your viewers love family. I love getting together. I have a son that lives in Israel,
Hmm,
and I worry about that little guy. He's 60 years old, by the
sure.
way. He's not a little guy, but
Yeah.
I'm just a family guy.
Mm-hmm.
But on the other hand, my mother taught me to help others, and to try to be kind to everybody you meet on the path of life. And I've tried to do that, Jeremy, and I will tell you, the outcome for me has been amazing. I hope it has been for the people that I've been with as friends and teachers. So I feel blessed, and I
Yeah.
think you do too about your life, from what I can see.
Yeah, absolutely. I think that's kind of the goal. It's not the money. It's not even the income. It's what do you do with that? And being blessed and being a blessing is definitely the way to
That's
go.
right.
And
I
I'm
agree.
glad to hear you're on the way. You're doing it as we speak. Good. Well, thanks for
Thank
coming
you.
on the show, Paul, teaching us
Thanks, Jeremy.
quite a bit about investing. And thank you for listening to the Retire Today podcast. If we believe if you know more about your money, you will feel better about your money and you will make better money decisions. Hi, I'm Jeremy Kyle. If you'd like to learn how my team can help you get more income, pay less in taxes, and avoid big retirement mistakes, head on over to kylefp.com. That's KEILFP.com.